Hi, I'm Jenny Brown. Welcome to our weekly buy-to-let market update. I hope everybody is well. Amazing weather yesterday. Today it's grey. I think we've got some sort of hurricane coming through at some point as well. But amazing to have the kids back at school, isn't it? I think I was not alone to delightedly pack my son off to school on Monday morning. I think it's obviously the best place for the children. I know that, I'm sure the kids are very, very happy to be back. I'm sure the schools are very happy to have them back. But most importantly, the parents are happy to send them off. So look, in terms of what we're going to cover for you this week, we've got our lender update. There's some really interesting news in there to share with you. We're also going to be talking about the latest update on the EWS1 reporting situation. And then finally, I'm going to be giving you some information on house prices, both in terms of what they have been doing and what the predictions are for the coming year and also for the next few years as well. So lots of interesting stuff to cover off today. So let's get on with our lender update. So first of all, I wanted to just talk to you about a proposition which is actually updated on a weekly basis because of the way the funds are priced, but I thought it was worth sharing because we haven't covered this one off previously. So Barclays do offer a limited company residential mortgage offering under their commercial proposition, so essentially limited company buy-to-lets. Now it is quite a restricted offering, but the rates are very, very good. So let's go into that in a bit more detail. So first of all, to be eligible for this proposition, you can only have up to 3 buy-to-let properties. So they're not going to lend to anybody with more than 3 properties, or actually they are going to, but it moves on to a totally different proposition, which to be perfectly frank is not very competitive at all. So this works for those people with just 1 to 3 properties. Now, up to 65% loan to value, you can have interest only. They can actually go to 70% loan to value, but that would need to be on full repayment. Now, if you are going on full repayment at 70%, you can have a 25-year term. At 65% interest only, it's a maximum of a 15-year term. Maximum loan amount is £1 million. Minimum loan size is 50,000, and the people who sit behind the company, and this is only company lending, do need to have income of £25,000 per year, and that cannot be from rental income. Now, the other thing here is that they are looking to lend only on standard properties. They will request personal guarantees and also take a debenture on the company which they're lending to. So far what I'm telling you is not sounding particularly exciting, but let me go into the rates. So first of all, the 5-year fixed rates start from 3.14%. 10-year fixed rates start from 3.41%. They also have base rate tracker rates, which start from 2.4% over Bank of England base rate, and a term tracker at 2.6% over Bank of England base rate, with a 1.5% fee. So those products are very, very competitive. We do get people asking for tracker rates. I think that's because people are kind of fairly confident that they're not expecting interest rates to go up anytime soon. And so actually, if you can get a tracker at 2.4 over base, the pricing is very, very good. So I thought that was one worth sharing with you. But like I say, a fairly narrow piece of lending criteria. Having said that, for landlords who have smaller portfolios, actually we're seeing a real surge in these guys coming back to market at the moment. So actually there really is a place for this, and it would have fit with lots and lots of people. Now, keeping on with lenders lending to those people with smaller portfolios for now, Lambay have released 4 new fixed rate products for non-portfolio borrowers. So again, they're terming these people with up to 3 properties in the background, and these are remortgage only products. Now, they're available to limited companies and individuals. And these are for companies with a maximum of 2 directors. Now, that's not the standard policy for Lambay. They can normally accept more directors and shareholders, but for these particular products, it's quite narrow. Now, the rates start from 3.14%. They're available at 75% loan to value up to 1 million. And they are doing a good stress rate, so a rental calculation based on the 5-year fixed rate pay rate. So actually, it's a really solid proposition for those landlords with just a handful of properties looking to remortgage, particularly because these products come with a free valuation as well. Now, Lambay have also made an announcement in the last week which pertains to their policy on blocks of flats or flats within a block. What they're saying is they're now able to lend on flats in blocks of greater than 5 stories again, and this kicks in from the 11th of March. They're going to be able to go to 75% loan to value, and they're not restricting the number of floors in the building. Now, what they also went on to say, and I'm going to read this verbatim, is that Landbay will consider applications in respect of properties over 5 stories high, but in order for these to be considered, there must be a valid EWS1 form in place at the time of the valuation instruction if the property has any external fire risk, such as cladding and or balconies, together with a fire risk assessment of the building as a whole. Now, they go on to say that if the fire risk assessment reveals that there are deficiencies in the building and that an action plan is requiring immediate repair or indeed longer term expenditure, then they're going to be asking details of how that will impact on the service charge before the valuation is instructed. So the EWS1 piece is a very, very hot topic at the moment, and we're going to cover that off in more detail shortly. But that's where Landbay's policy sits on that. Okay, so also in the last week, we've also seen LendInvest make the announcement that they're changing from LIBOR to bank base rate. Now, for those of you who watched our video last week, we talked about the fact that LIBOR is going to be finishing, and that lenders will be looking to move their pricing across to potentially one of 3 kind of structures. They may move across to SONIA, they may move across to bank base rate, and they may move across to just a standard variable rate. So LendInvest have chosen to move to Bank of England base rate. We've also seen in the last week Zephyr Home Loans release 3 5-year products for like essentially a spring special, a kind of incentive period, with pricing starting from 3.19% at 65% loan to value, 70% at loan to value, with rates from 3.39. And all with a minimum loan amount of £200,000. Now, these products come with an arrangement fee of 2% of the loan amount, and there's no application fee. Now, the good things about dealing with Zephyr is that they're very, very landlord friendly. So again, they're very comfortable lending to those people with large portfolios in the background. And these rates are available for limited companies and also individuals. Where does the pricing sit in the market? It's actually quite good. So good news for our landlords, particularly those who are portfolio or limited companies. Lastly, we've seen Skipton make yet another round of repricing. I seem to bring them up every other week at the moment. And essentially what they've done is they've kind of rejigged things, I think. So we've seen some of their pricing come down by up to 20 basis points. Other rates have gone up by up to 11 basis points. They now have pricing starting from 1.69%. Now, as we've talked about previously, Skipton have a really solid offering at the very vanilla end of the market. So up to 10 properties in the background. They do have a minimum income requirement. They're not lending on anything other than very, very standard properties. But, if you are a landlord who fits within their criteria, then the pricing is very, very good. So just sticking with mortgage lending for a moment, the Bank of England have published some statistics that I just wanted to share with you. So what they have told us is that the value of new mortgage commitments in Q4 of 2020 was 24.2% higher than it was in the same quarter in 2019. So there was 87.7 billion worth of new mortgage lending, which is the highest level since 2007. Now, that can obviously be attributed to the fact that the first, 3 months really, but particularly the middle 2 quarters of 2020 were very, very slow quarters because of, for obvious reasons. But obviously then we saw a massive flurry of activity towards the back end of last year, which was largely people looking to move house with the stamp duty holiday, and obviously the fact that people have been looking to move house for some time and had really been able to get going. Now, what they also went on to say is that the share advanced to home movers increased by 8.9% on a year earlier to 36.9%, which is the highest share for home movers since 2010. So that really just reinforces the point that I've just made, that actually the back end of 2020 there were, a lot of people moving house basically. Remortgaging, interestingly, totaled 18.5%, which represented a decrease of 10.7% since Q4 of 2019. Now, the other statistic that I just want to share with you that I think is just quite interesting to note is that the value of outstanding balances with some arrears increased by 3.4% over the quarter, meaning that £14.3 billion pounds worth of mortgages are now in some state of arrears. And this now accounts for 0.93% of outstanding mortgage balances. So a really large uptick in terms of people not being able to meet their mortgage commitments. It's an interesting one because I think a lot of people have been making use of the mortgage payment deferral scheme, which really should have helped kind of cover people over that period. I do wonder if lenders have recorded those internally as arrears. It's hard to say, but that was the data that was published, and I just thought it was quite interesting to share. Okay, some really good news for you now with regards to EWS1s, particularly for those of you who have properties or flats particularly where you've had some problems with the EWS1 requirements. So RICS have released the valuation of properties in multi-storey, multi-occupancy residential buildings with cladding guidance, which clarifies the types of properties which will and those which will not require additional inspections as a result of concerns about fire safety. So now what's going to happen is that RICS is going to work with the UK government and other stakeholders to ensure the guidance is implemented by the 5th of April this year. Now, what they've gone on to say is that in order to assist consumers, RICS are shortly going to produce consumer guidance to inform buyers and sellers about the information that might be available to help them understand the risks of a property in a multi-storey, multi-occupancy building. And what they're saying is that this guidance now creates clarity and consistency about when a valuer is not required to request further investigation of cladding through an EWS1 form before valuing a property in a building of multiple occupation. So to break this down for you, here is what they are saying. For buildings over 6 storeys, an EWS1 form should be required where there is cladding or a curtain wall glazing on the building, or there are balconies which stack vertically above each other, and either both the balustrades and decking are constructed with combustible materials, so for example timber, or the decking is constructed with combustible materials and the balconies are directly linked by combustible material. For buildings of 5 or 6 storeys, an EWS1 form should be required where there is a significant amount of cladding on the building. For the purpose of this guidance, approximately 1/4 of the whole elevation, estimated from what is visible standing at ground level, is a significant amount, or there are ACM, MCM or HPL panels on the building, or there are balconies which stack vertically above each other and either both the balustrades and decking are constructed with combustible materials, or the decking is constructed with combustible materials and the balconies are directly linked by combustible materials. Now, and here's the one where I think people are getting really frustrated, the lower storied buildings. So for buildings of 4 stories or fewer, an EWS1 form should be required where there are ACM, MCM or HPL panels on the building. So they've made it much more clear, I guess, in terms of where an EWS1 would be required. Now, I think it's fair to say that from our experience on this, if a valuer goes out and they look at the property and they have concerns over the fire safety, even if the property does not directly meet these guidance notes, they are still within their rights to ask for an EWS1 form, which is incredibly frustrating when it happens. But obviously the key point here is that everyone's trying to make sure that the properties are safe for the people that live in them. But like I say, it's really good that we've had this clarity going forwards. It's really going to help. Particularly for those people whose freeholders have held off getting these EWS1 forms put together because they've been waiting for this guidance to know whether it's something they actually do need to do. So really, really great steps forward for so many of our clients who have been struggling with this. And now moving on to house price news, both looking backwards and also looking forwards as well. So first of all, house prices fell by 0.1% between January and February of this year. However, annual house price inflation remains strong at 5.2%, and this is according to the latest Halifax house price index. The data also shows that in the last quarter, so December to February, house prices were 0.5% higher than the preceding 3 months. So there's some news there in terms of what has been happening. But I think more interestingly, looking forwards, Savills has raised its housing market forecast to 4% price growth and 1.4 million transactions this year, following what they're terming a property market friendly budget. Their house prices were forecast to rise by 21.1% over 5 years, with the UK average value expected to reach £279,664 by the end of 2025. And the rate of growth is expected to peak at 5% in 2022, although the analysis does here exclude new builds. So transaction volumes were forecast to return to the normal levels of about 1.2 million per year by 2023. Now, Savills forecast the strongest price growth over 5 years in the Northwest at 28.8%, Yorkshire and the Humber at 28.2%, and in London growth was forecast at 12.6%, and in the South East at 17%, which is supported by housing equity, which would help overcome income constraints. So I think really what we can take away here is that even though some people are still expecting that the coming few months might be tricky for the housing market, and I have to add that we're not actually seeing that at all from where we're sitting, but there are still some people who have real concerns. Actually, the growth forecast for the sort of midterm, so over the next 4 years, is actually looking incredibly strong. And that is us for this week. As always, thank you for joining us and taking the time to hear what we have to say. And as always, our consultants would be delighted to have a chat with you if you have any requirements or questions. 0345 345 6788, and our website is open 24 hours a day, 7 days per week, so do go and have a look on there when you've got some time. mortgagesforbusiness.co.uk. I hope you survive the high winds that we're expecting. Keep warm and dry, and let's hope the weekend weather is kind to us. I think we could all do with a few hours in the sunshine, and I will catch you next week. Until then, take care.